Matthew, thank you very much for being here today. A pleasure speaking to you. I'd like to start by asking about CoStar, about your company. For those that still don't know what you guys do, you are a global leading company in your field, but if anyone doesn't know, how could you explain?
So CoStar is the leading provider of information analytics and online marketplaces in the real estate markets. We operate in the US, the UK, and Canada, and now globally. And in the UK, we've got CoStar and LoopNet platforms, which are our global data analytics and digital marketing offerings.
Wonderful. One of the topics that we have been discussing a lot in the market right now is the price alignment between sellers and buyers. Some say that it's the right time for acquisition. Some say that still need some time for price adjustments. When you look at your data and your information, what do you have to say?
So we had some fascinating talks yesterday from Megan Monters at PIMCO and from James Purvis at Hines that set out the macro picture really, really well and showed that those leading indicators around the financing markets and the comparison between finance rates and long-term risk-free yields is now attractive enough. So the big picture is ready, but that was a big counterpoint to the market participants who were in the room, who still had a few more misgivings and complexities around occupational markets. So there's an interesting moment now where the consensus is 2024 could be the bottom of the market, could be your 2009 compared to your global financial crisis, but it still may take more time before market participants and their investors have the confidence to invest and have the data and understanding that allows them to invest with confidence in that market.
What are the main questions that you hear from your clients nowadays when they are trying to work on the decision-making process about going ahead and acquiring a building or not? What are the main things that are coming to the questions?
Mm-hmm. So the big challenge that our customers face at the moment is the increasing complexity in particularly the office market. And the retail market's been diverse and formed differently in different ways for a long time. But when it comes to the office market, people have relied on grade A and grade B and very broad definitions of how an office is likely to perform, for example. What we're finding now is that real micro locations, real asset-specific criteria are defining performance. And so the challenge that our clients have is, how do we justify to our investors that we're going to double down on investing in the office market, despite the fact that our American investors are seeing absolutely terrible performance in many of their markets, or despite the fact that the overall net absorption is negative? Well, what we're helping people to see is that nuanced understanding of assets which are within the right micro locations and how they're performing, within the right standards and quality and how they're performing compared to the rest of the market. And that was one chart which our UK analyst Mark Stansfield showed, which is negative net absorption has been pretty consistent in the UK office market over the last 2-3 years. But the one sector that's outperformed is the 5-star office sector, which is the very, very best. That's a simple example, just the absolute very best. But what our clients are finding is that this grade A definition, which has been around for a long time, is not sufficient. Grade A is actually needs to be split into two, and the real top class assets are outperforming. And you might know that as a market participant, but actually you've still got to justify that to investors when you're making significant allocation of funds, particularly speculative. So you need that data to underwrite it. So that's what we're spending a lot of time on with clients at the moment.
Very interesting. And when you try to understand the difference between, let's say, London and New York, in terms of performances of having different kind of asset prices in the short terms from when you look at the data.
So what we're seeing now is the biggest spread that we've got on record between vacancy rates in London and New York. As a great chart we've got that just shows how that's increasing and increasing. That trend isn't yet changing, so we're seeing that trend continue to, that spread continue to broaden. And there's been some fascinating conversations actually over the last 2 days about what drives that difference, not specifically London and New York, but what makes certain cities even better. And one particular point which is clearly material between Europe, but for example the UK and the US, is the commute time. and how dispersed a lot of these US cities are. The bet, though, is that New York is concentrated enough with a strong enough transport network that it doesn't need to follow the same pattern as the West Coast. And so there was some good analysis yesterday from Megan's presentation, which looked at the kind of demographic spread and showed New York actually to be more of an outlier. So it'll be interesting to see how it plays out. One other area is placemaking, and if you look at London compared to New York, you do have these large swathes of the city that are controlled by single owners that allows them to actually make the place. And so if you go to somewhere like Covent Garden, or you go to Soho, you go to Canary Wharf, you go to Mayfair, Belgravia, those owners are able to bring together the right mix of uses. And that's something that is a real benefit for London, because it makes it an attractive place to be. Whereas if you've got every individual asset owned by a different owner, they're going to go for someone that's going to take the longest possible lease and underwrite their investment value, and be damned with who the other occupiers are along the street and whether that creates a good experience for the place overall. And so, yeah, I think those dynamics are good for London. A huge audience within an hour's commute, and they're attractive places for people to actually come to when they do come into the office.
100%, very visible. And just a final question: when you look at the whole turbulence that rough sector is facing, of course, we all believe that we will have some adjustments and we will settle at certain point. But do you believe this is the new normal for the level of occupancy, or the level of companies that will ask people to work from home or work from the office? Do you believe this is the new normal? Do you have any kind of data that would indicate that this might stay for longer?
Well, one thing we've done with our forecasts, we've got a very consistent forecasting methodology across all of the sub-markets we cover in the US, the UK and Canada. And we've always had a connection between our anticipated office net absorption and job growth in certain sectors, because those sectors are connected with taking more office space. So, for example, historically the technology sector, if it's growing, that's going to have an impact on net absorption in the office market. But what we've seen is that connection has started to decouple, that actually we've had to adjust our forecasting methodology because we're seeing hiring, for example, in the technology sector, which isn't necessarily having the same connection with office take-up. And so I suppose we've seen a big adjustment to social adjustment. This one I noticed in my own home. My wife and I both used to go to the office 5 days a week. I think everyone's experiencing that change in their personal and professional life. But actually, we have had a big dislocation and there will be a normalization now as companies get more confident in what they actually need the office for, and solidify the requirements of people to come back to the office. And so I suppose over the next year or two, we'll start to understand what that looks like. But there was a very interesting point made yesterday around retail and the fact that you had the impact of real estate on retail sales dropped by 25 to 30% when customers went online. So real estate became the less important part of that retail journey, of that a less important channel for retailers. And if you see the same point here with offices, where 25 to 30% less space is being used, that is something that could take 5, 6, 7 years to actually really help us to understand what impact that's going to have on the market. But when it comes to a location, and to our point earlier, if you look at the performance of locations that are really close to mainline train stations, that are really high quality assets, that's actually much more attractive. So, because if people are coming in less, we want them to be easily getting into the office. And if you want them as an employer to come in more, which most employers do, ultimately, most employers, as long as it wasn't making them lose staff, would rather have more people in.
Yes.
They want to make it as attractive as possible. So really high quality, really close to public transport, giving you all the amenities that you need in an attractive area. Those assets are going to continue to perform well, and I'm sure, and they're consistent. That's consistent with our data, but it's also consistent with what you hear in the data.
What you can see and we feel, right? Again, makes sense. Isaac, thank you very much.
All right, and thanks. Cheers.